Hey gang, how's it going? Anthony Carr here with Anthony Carr Associates and KW United. I want to talk real quick about the 1031 exchange option for a lot of people that own investment real estate property and they want to roll that over into another investment property without paying capital gains taxes. So let's talk a little bit about that and see how that works for you. First thing is the main benefit of the 1031 exchange, and 1031 is the section of the IRS code that covers these, is that it allows a real estate investor to sell one property and purchase another, roll all the funds over into that second property, and not have to pay any capital gains tax for property that they may the gain they may have made on that sale of the first house. For example, you could have a rental property, a rental condo, single family, and you decide to sell it and you want to go buy a commercial property, or you want to roll it into a Delaware statutory trust or into some other like kind real estate investment. And so it does not have to be for single family and residential to residential. You can go over to cash to commercial, or you all could also go into land, vacant land, and maybe invest in something where you're going to be having a tree farm. One property can be exchanged for multiple properties is another thing. So if you have a more expensive property here in Northern Virginia and you want to buy something in St. Louis or closer to your hometown, which may be a little bit less expensive than Northern Virginia, not too many places where that wouldn't be true. You could roll those funds over into two properties, three properties. The key is that all the proceeds have to go from point A to point B, and it has to be the same value or higher. So let's say you make you sell $750,000, but then you have a gain of 500,000. The next property has to be $750,000 or two properties, or three properties that would eat up that $750,000 price range. So there's a little bit more involved in that than just buying and selling. The other is you have a relinquished property. That's the one you're selling. And then you have a replacement property. That's the one you're purchasing, or the several that you are purchasing. That money then has to go to a qualified intermediary. You can't touch that money. Once you've touched it, you now owe capital gains tax. So the qualified intermediary is a secondary firm that receives the funds at closing, and then they hang on to it until it's time for you to roll that money over into your next property. And so that way you're not touching it. There's a little bit of a fee there, maybe about anywhere from $800 to $1,000, and then they hang on to it, ready for the next purchase. So you have to use all that money. We just talked about that. It's got to be the same value of the property than what you're selling. And once sold, you're on a timeline now. You must identify the next property, the replacement property, in 45 days, and then you have 180 days to go to closing. Now, the 45 days is included in that 180. So if it takes you 30 days to find the property, you now have another 150 days to go to closing on that secondary investment. So that's the basics of the 1031 exchange. There's a whole bunch more of information on that than what I just shared with you. If you'd like to talk a little bit, you can call me at that phone number, 703-819-9800, or you can scan your phone and send me a text right away. Thanks so much. Have a great day, and thanks for listening to my channel. If you like it, share it with somebody, and you could subscribe, and then you'll notify them whenever I have a new video that comes on. Thanks so much, and have a great day.